Nvidia just became the first company in history to touch a $5 trillion valuation. Weeks later, its stock fell into what Wall Street calls correction territory. Got a 401k? Subscribe and tap the bell. This could affect your money more than you realize. That same month, one of its biggest AI partners suffered its worst week since the dot-com crash, dropping nearly 19%. So which story is true? Is AI still the smartest trade of our generation? Or did we just watch the first real crack in the next massive bubble? Stay with me, because by the end of this video, you'll know exactly where the real risk is hiding, and it's probably closer to your own bank account than you think. Here's the problem with the AI stock story right now. Nobody's telling the same story twice. One headline says Nvidia is unstoppable. The next says a hedge fund legend is betting against it. Your coworker won't stop talking about his Palantir gains. Your uncle keeps saying it's just like 1999 all over again. Meanwhile, you're checking your retirement account, wondering if you're in, missing out, or about to lose. Let's get into it. Part 1. The boom is real. Start with why anyone cares about AI stocks in the first place. This isn't hype for hype's sake. The money is almost hard to picture. The four biggest U.S. tech companies are projected to spend well over $800 billion in 2026 on AI data centers, with global AI infrastructure spending expected to reach $2.9 trillion through 2028. Nvidia, the company making the chips behind almost all of it, is worth about $4.8 trillion today and pulled in more than $130 billion in data center revenue over the past year, at close to 75% gross margins. That's not vibes, that's cash. Even Elon Musk's SpaceX went public this year at a valuation bigger than any IPO in history, and analysts are already framing it as an AI infrastructure play because of its computing clusters. The broader market followed along. The Nasdaq just wrapped its best quarter since the 2020 pandemic rebound, up more than 21% in 3 months. PwC analysts project AI could add up to $15 trillion to the global economy by the end of the decade. Even if that number ends up being generous, it's part of why so much money keeps pouring in. So yeah, the boom part, completely real. But here's what almost nobody was saying 3 weeks ago. Part 2, the cracks are showing. In late June, something broke. South Korea's entire stock market had to halt trading. Samsung and SK Hynix, two of the world's biggest chip suppliers, lost 12% in a single morning. Hours later, the Nasdaq dropped more than 2%. Oracle, one of the companies pouring the most money into AI infrastructure, closed out its worst week since the actual dot-com crash, down 19%. And Nvidia, the same company that just made history at $5 trillion, fell about 12% for the month of June alone, right into correction territory. Michael Burry, who famously called the 2008 housing crash, has expanded shorts against Nvidia, Palantir, Oracle, and even broad tech ETFs like SOXX and QQQ. In his view, this ends the way every mania eventually ends. Part 3. The numbers behind the fear. Here's where it gets uncomfortable. The S&P 500 opened this year at its second most expensive valuation since records began in 1871, behind only the dot-com peak. Palantir, one of the hottest AI names on the market, was trading earlier this year at a price-to-sales ratio north of 80. Historically, valuations above 30 have often signaled higher risk. Zoom out further and it gets bigger. Hyperscaler capital spending now equals roughly 1.3% of the entire U.S. economy, and it's projected to climb to 1.6% this year. That's an enormous bet, concentrated in a handful of companies. There's a productivity problem too. Recent studies show about 21% of S&P 500 companies now report measurable AI-driven productivity gains, though many firms are still waiting to see results, highlighting the ongoing productivity paradox. And then there's the debt. Oracle raised $18 billion in bonds last year just to keep building. OpenAI has announced plans to spend $1.4 trillion over 8 years, against roughly $13 billion in revenue. Morgan Stanley estimates almost half of all AI data center spending through 2028 will come from borrowed money, not earnings. If this is helping, tap like. It helps more people find this video. Part 4. Why it's not that simple. Before you panic and sell, pause. Back in 1996, legendary investor Jeremy Grantham warned tech stocks were dangerously overpriced. He was right, eventually. But anyone who got out immediately missed the Nasdaq climbing roughly 376% over the next 4 years before it finally crashed in 2000. Being early can look identical to being wrong, sometimes for years. And here's the twist. In 2026, the Magnificent Seven have lagged the S&P 500, earning the nickname Lag 7. Nvidia, still profitable, trading at 30 times forward earnings, cheaper relative to growth than a few years ago. Goldman and Morgan Stanley both argue we're not in a full bubble yet. The honest truth? Nobody knows. Not billionaires, not hedge funds, not TV pundits. Certainty is just another product being sold. Part 5. What this actually means for your money. Here's what matters most. Even if you've never touched an AI stock, you're exposed. An S&P 500 fund has about a third tied up in just 7 companies. Nasdaq 100, closer to 40%. Step 1. Check what's inside your 401k or index fund. Most people never do. Step 2. Stop trying to time the top. Dollar cost averaging beats guessing. Step 3. Diversification isn't boring, it's protection. Equal weight S&P 500 funds are one-way investors spread exposure across all 500 companies. And if you have room to invest more this year, contribution limits went up for 2026. For 2026, contribution limits are $24,500 for a 401k and $7,500 for an IRA, with catch-up contributions of $8,000 for those over 50 and $11,250 for ages 60 to 63. That's more tax-advantaged room to build wealth slowly instead of chasing headlines. This segment is sponsored. If you're looking for flexible remote work and you're eligible, Handshake AI connects students, professionals, and experts with paid project-based opportunities that help train and improve AI systems. Check the Handshake link in the description to learn more. Part 6. What to watch going forward. A few things worth tracking. Interest rates matter enormously here. The Fed just brought in a new chairman, Kevin Warsh, and instead of the rate cuts everyone expected, he's hinted at possible hikes later this year because inflation has been running hot. Higher rates hit expensive growth stocks the hardest, AI included. There are also fresh reports that OpenAI's IPO has hit delays, and separately, that it's in talks to sell a stake to the US government. Whatever comes of it, it tells you that funding this boom is getting more complicated, not less. Watch whether AI spending keeps getting funded by real earnings or increasingly by debt. That shift is one of the clearest warning signs in every bubble before this one. And keep an eye on productivity data specifically. If AI starts showing up in company earnings in a big way, that's the bull case proving itself. If it doesn't, expect the bears to get a lot louder. Let's bring this together. AI spending is real, measured in the hundreds of billions of dollars. Valuations and market concentration are historically stretched right now. A more hawkish Fed could pressure expensive growth stocks further. Nobody, bulls or bears, has a perfect record calling the top. Know your exposure, diversify, and invest with an actual plan. I'm curious to hear from you. Do you know how much AI is in your 401k? Are you buying this dip or staying cautious? Drop your thoughts in the comments. I read every single one. Remember, this video is educational only, not financial advice. Subscribe for more personal finance content. Thanks for watching.